Perfect. I think we're live now, so we can get started. Hello, everybody. Welcome back to our Tech Talk follow-up, following up on the Tech Talk we had a few weeks back. So in the past Tech Talk, we were talking about stablecoins in practice. And now we're looking at how builders are actually navigating that multi-rail shift. So last time on our multi-rail money movement Tech Talk, we had a ton of interaction. We had a ton of discussion, more than we can actually address live. And many of you asked, okay, how do I bring that live? How do I bring that into production and make that a reality for my customers? So we're going to focus on that today. For anybody who wasn't here last time, my name's Matt. I manage our payment products here at Modern Treasury, and I'll be your host today. Joining me again are Sam Aarons, our CTO and co-founder here at Modern Treasury. And then also we have Dan on the line. Dan is our head of stablecoins. Thanks both of you for joining, and super excited to jump in. Before that, just a couple of quick housekeeping items. The session is being recorded and we'll share it afterwards. And then also this one is built to be interactive. So if you have questions, make sure to use the chat to add your questions. We'll make sure to go through as many as we can, and we can follow up afterwards if we don't get to them. We're also going to send out some polls during that to sort of get your feedback and help us drive the conversation. Perfect. So before we get practical, we're keeping our tradition here at MT, starting off fun with our food hot takes section. So these are deliberately controversial, no hard feelings if there's disagreement, and we're bringing something new. I'm going to kick it off here, something a little bit seasonal, although we're already in January. Panettone. I think it's super overrated, not my thing. So panettone is a no for me. Sam, what have you got?
My food hot take is that all custard-filled desserts, eclairs especially, are better with whipped cream. Whipped cream is a better substitute for custard in almost all desserts.
Nice. I don't know. I don't know where I'd sit on that one. Dan?
It is controversial, but I think that's, especially if you're coming from France or somewhere where, that traditionally eclair is custard, I think it's better with whipped cream.
There we go. Stirring up a spicy take. Dan, what have you got?
So I'm in SF this week, and for folks that aren't aware, MT has offices in both SF and New York, and I'm usually in New York. This is one that's debated frequently on the Modern Treasury team, but I'm of the firm opinion that the sandwich market is much stronger in San Francisco. I think New York sandwich makers tend to overdo it across any dimension of sandwich, artisans. So happy to be in the Bay Area and happy to consume some sandwiches while I'm out here.
Perfect. I guess in the Bay, they're only adding 5 slices of meat instead of 10, so it's a little more reasonable. Cool. All right. So we've passed off our food hot takes. Now we're going to focus on our money movement hot takes from here on out. All right. So we're going to jump in. As I mentioned before, please add your questions that you have based on what we're discussing to the Q&A section. We'll make sure to go through those after we've had a chance to run through our first initial topics. So I want to dive in straight into what we discussed, which is, okay, we have multi-rail money movement. We've talked about it in theory, but what does that actually look like in production? So rails are accumulating. There's a clear shift in expectations to things being instant and 24/7. And as that's happening, people are adding these new rails, but every time a new rail comes along, they don't want to have to completely rebuild their stack. So let's get concrete about, somebody's launching a product here, early 2026. What does that look like? So Sam, I want to jump over to you. When a team of builders are saying, we want to go multi-rail, what are they actually signing up for operationally? What's the first thing? What's the first obstacle they're going to run into? Is it orchestration, ledgering, exception handling?
It's definitely exception handling. I mean, out of those three, I think exception handling is the first thing you hit. I think when teams say they want multiple rails, what they're saying is, hey, I want to meet my users where they are. And we're kind of entering this world where it's the users who are deciding, hey, I want my money instant and I'm willing to pay for that. Or I'd want it a little bit slower. I'm not willing to pay for it at all. And so we're seeing, consumers mostly, but businesses as well, and B2B payments we're seeing the end users decide where they lie on that, time value money spectrum. And we're seeing a lot of consumers choose, hey, I want my money instantly and I want it right now. I think what that means for the teams, though, is that there's a lot of systems and ops work that you have to build in to your existing system to make that work. Exception management is probably the biggest one that comes to mind. I mean, all these rails, let's just talk about the United States for a second. If we're talking about ACH and FedNow, and let's throw in FedWire, right? Those are three different systems. Of course, they behave the same underneath the hood, right? It's transferring value from A to B. But how they operate behind the scenes, the exceptions, the things that can go wrong, all the rules and regulations between each of these three systems, which are all wildly different from each other on purpose. That takes a lot of work. And so what teams are signing themselves up for is a lot of understanding, right? The technical work may not be a huge lift, but the operational work to understand how these systems work, to be able to respond effectively, to understand the rules and regulations, they all are fundamentally similar, which is why, they can be addressed using similar APIs, but it's about knowing the nuances and differences between them. That I think really trips up a lot of teams. And especially when you're dealing with instant payments, like in the case of FedNow or RTP, you can't really make any mistakes, right? If you make the occasional mistake with ACH or with wires, it's somewhat recoverable. People are kind of a little more lenient, but you can't really make a mistake with FedNow, right? If I'm, let's say, initiating a payout on a platform with my phone, I expect to see that payout in my bank account by the time I've tabbed over to my banking app on my phone after I've exited whatever app I'm using. So there's very little tolerance to get anything wrong because the expectation of instant is instant. And there's an additional expectation on top of that because most people who are offering instant payments are also collecting money for that instant payment. So there's an additional expectation. Hey, I paid for this instant experience. I need my money now in my account. So you see that a lot. So, you're really signing up for a lot of different things that you have to bundle together, but that's the way the world is going. It's going more towards multi-rail.
Super fascinating. So here at Modern Treasury, we've actually supported some of these instant rails in the US for a couple of years now. To get really tangible, do you have any examples of lessons that Modern Treasury has learned as we've rolled out those rails, FedNow and RTP?
I mean, so many. I mean, here's some interesting ones, right? Let's take FedNow, right, which launched just a couple years ago. FedNow originally had a cap on the amount of a transaction. It still has a cap, but that cap is now, I think, $10 million, if I'm not mistaken. But that cap wasn't always 10 million. So as a service provider, as a user of FedNow, you have to constantly be on top of the rules because that limit kept changing over the past 2 years. You also have to be on top of routing, right? Only a few banks supported FedNow at launch. Now it's much more. I think the last time I looked at a Fed press release, they said over 1,100 banks. That's 1,100 banks that have added over a 2 year span. That list is updating monthly. And if you want your customers to have the best experience possible, you have to be able to support their bank. And so there's this whole, if you're building this on your own, there's this whole apparatus you have to build to essentially make sure that, oh, is this routing number FedNow eligible? Let's keep that up to date. Oh, it has to happen manually. Let's build a system and a process for that. So that's just one example, and that's a rapidly changing rail. But let's take a rail like ACH, which has existed since the 1970s. Nacha, which is a great organization, has been continuously changing the rules on different aspects of how you use ACH. Not most recently, but a couple years ago, they changed the rule on micro deposits. Everyone here has probably dealt with a micro deposit, right? You enter in your account routing number, the counterparty you're dealing with sends you two small amounts. You wait for that amount to arrive, you go back to the website, you enter in the amounts to verify, and you click submit, and they take the money back. That was a pattern that had existed for, at least a decade. But Nacha came in and say, hey, we want to formalize this. If you're doing this pattern, you need to update with this description, these transactions, you have to change these rules. And, that's something that if you as a user of the ACH system have to be aware of. And so there's all these changes and payments going on that for most people feel behind the scenes. But if you're really getting into a multi-rail world, you are now multiplying the amount of things that you have to think about, or you get a service provider who takes care of these things for you.
That's fascinating. Dan, I want to jump over to you. So Sam's talked a lot about these rails that do have these centralized governing bodies. So you've got NACHA, you've got the Fed. In the stablecoin world, it's a lot more fragmented. It's a lot more decentralized. Do you have any examples from that side on digital rails that you can share in terms of how to handle exceptions?
Definitely, and I think stablecoins are interesting because we hit on this a little bit in the last discussion related to kind of multi-rail money movement, but historically the kind of infrastructure set and various market participants that have come together to create the stablecoin ecosystem have been very trading centric. And so there's still limitations and kind of room for improvement broadly in creating governance bodies and standards through which stablecoins can be used for payments. Full stop. I think there's some interesting stuff that's happening across the market, ranging from things that large stablecoin issuers are doing down to early stage startups, which are focused on effectively establishing frameworks through which stablecoins can be used for payments. But ultimately, I think that's still a kind of a burgeoning part of the ecosystem. I think that said, there's this concept that we've been chewing on a lot at MT, which is basically like kind of not only the fragmentation of various blockchains and stablecoins and underlying crypto infrastructure, but also like even with the improvements that's happened over the past, call it 12 to 18 months with stablecoin orchestration, there's still this kind of binary world that exists between stablecoins and fiat. And so we've been kind of mulling on this concept of stablecoins have a fiat problem, which is basically to speak to the fact that these two systems need to coexist more cohesively, and they can do so. And moreover, the way that we have been thinking about things are that stablecoins are another payment rail that should sit alongside rails like ACH and RTP. And so to weave that all together, I think, again, room for innovation and kind of the establishment of clear frameworks through which broader market participation can happen. Moreover, kind of room for improvement and room and space in the market to create infrastructure that makes it easy to enable both of these tools alongside each other, which effectively can be match made at some point in the hopefully near future to allow for this big unlock that I think people in the market are waiting for to get us away from a world in which stablecoins are used for kind of crypto native only use cases and to get us to a world in which more traditional businesses really across any dimension of the payments ecosystem can use the right tool for the job, which in some cases can be stablecoins.
Yeah, for sure. I want to dig a little bit deeper there on talking about actual examples of effective pairings where you've got stable coins on the left hand and fiat on the right hand. I know something that you and I have been working on a lot over the past few weeks is how to build an effective way to on-ramp onto crypto. How can rails like ACH that have effective, debits programs, how can those be leveraged in tandem with stablecoins to get some assets on chain quickly? Do you want to share some of the learnings we've had over the past few weeks in terms of how we can build that experience for customers?
Yeah, definitely. And funnily enough, I think like the ACH debit transaction type is probably the least utilized transaction method in market for the purpose of funding an on-ramp use case. And I think that frankly needs to change. And to Sam's point, especially on the consumer side of things, I think the market is pushing us all towards a reality in which we will all be forced to accommodate certain consumer expectations as it relates to how money moves into blockchains and respectively stablecoins. So to double click on that, I think there's a reason why ACH debits have been underutilized as a transaction method. ACH debits are a tricky transaction type, which the people at Modern Treasury know, and I think people broadly that are attending this session very well know. To Sam's earliest point in this discussion, a lot of the issues, if you will, or the complexity arises with exception handling. And given the fact that there are delays around when the money actually is moved from the end user's checking account into the ecosystem, and then with the addition of the fact that not only do you need to consider money having moved from a consumer's DDA into broadly a payments platform, you need to then couple that with how liquidity is managed to move that value into a stablecoin, and then value transmission happens on a blockchain to deliver that stablecoin somewhere. There's ultimately a lot of work that still needs to be done to figure that all out. And yes, to your point, we've spent a bunch of time thinking through what that could look like to abstract away all that complexity away from the user, most importantly, but secondly, abstract away a lot of that complexity from possible customers of the modern treasury platform. And so it's just I think it's a hot topic for myself and Matt, for you personally, given the fact that I don't know, I'd say roughly, like, finger in the air, maybe 80% of discussions I'm having with market participants that are evaluating usage of stablecoins, they're centered around how to make it easier for a consumer to move value into broadly a wallet type. And in this case, the wallet is a crypto wallet. So that's one example. I think historically, from kind of the Beam days, and as Beam transitioned more fully into modern treasury, which is now being completed, um, I think RTP and FedNow and some other stuff that you can do with the card networks like push to card have been interesting tools that I think a few market participants have adopted, and I think have used them to create super novel, super impressive user experiences. I would say, in my opinion, and this is obviously biased, and I'd say is probably biased by my background from the instant payment days at Visa. I do think that RTP and FedNow and push to card as well are still underutilized in market as it relates to using them for off ramping from a stablecoin balance. Again, there are some folks that have use these tools to fix that, but ultimately, like, I view all of this, to kind of wrap it back up to the main point, like, the way that I think about this is that each fiat payment method can be used as a tool to move value into a blockchain or out of a blockchain, and ultimately the end user will decide and kind of tell both platform developers and then infrastructure developers like ourselves where they want to go. And I can say with confidence that, at least as it relates to the consumer market in stablecoin land, things are pushing closer to a world in which the instant expectation also persists in stablecoin use cases, where stablecoins are being used under the hood to build a novel fintech experience primarily.
Right. I think it's no longer correct to talk about the choice between wire or ACH for getting money in and out of these on ramping platforms or off ramping platforms. We talked a little bit about underutilization on the instant credit side for RTP, FedNow, push to card. We also have a new entrant in the space on the debit side. ACH debits have been around for a long time. They serve a great purpose. You can control when they're initiated when you're in the platform, but there are some, time delays. There are returns, of course, that you have to manage. Sam, I want to jump to you and talk a little bit about RFP and how instant debits could be used to take that pull money in on the left hand and on ramp on the right hand into an even more effective and truly instant flow.
Yeah, so for those of you who are not aware, RFP, request for payment, that's the ability of the FedNow system to essentially ask someone for money. So if you've ever used Venmo before, it's very similar to a Venmo request, where instead, or you put in the person's information and then they get a request from their bank saying, hey, Sam is requesting $100, and then you can click approve or click decline. And when you click approve, the money's in my account instantly, just as if you had sent me a RTP credit or a FedNow credit. So it's a very good user experience. I think it's something that consumers especially are very used to. I want to go back to something that Dan said just before I continue on RFP, which is that ACH debit is a wonderful rail because users understand it, right? They just put in their information and they say, take the money out of my account. It goes out of their account. They're like, great, it all worked. I think users of ACH debits, or the recipients of ACH debits, love it. It's a great friction-free rail for the most part. There's maybe the micro deposit part, but after you get that done, ACH debits is wonderful. I think what's difficult is for the businesses and the organizations that are originating those debits. That's where all the risk comes in. I think you mentioned on it just now, Matt, like, it's the return risk, it's the reversal risk, right? It's the risk that if you debit me, that I'm a potentially bad actor. And given the rules of the ACH system, where I as a consumer have 60 days, right, 2 months to essentially return an ACH debit that I don't like, right? That creates friction, that creates risk, that creates especially fraud risk on the organization that's originating that debit. And so we as, consumers, we love ACH debits, but it's the businesses that are kind of figuring out, okay, is this right for my use case, right? It's probably good for utility where you're paying a power bill, right? No one wants to, get out of paying their power bill. If you're paying your credit card bill, also makes sense, right? If you try to do any funny business with your credit card provider, they shut off your credit card. And so there's ACH debit is used in a lot of cases where there is some kind of recourse or some kind of external way that can ensure that both sides really play fair. And I think in these account funding, and I know, on-ramp to stablecoin, it's not exactly a account funding scenario, but just for the purposes of this, I'll put it in that bucket. If you're looking at a pure account funding model where you just need to get money in the door because you're going to do something with it instantly, right? The organization is taking on a risk there. I was at a conference a year and a half ago, I believe, where there were gaming companies talking, think of DraftKings and FanDuel, companies like that. I can't remember the specific one. And they were talking about, yeah, it's a risk. Like whenever someone deposits money in the platform because they want to make a bet and the bet doesn't go their way, they are more inclined, however rational it is, to try and play games with the ACH debit system in order to get their money back. And if you now apply this to stablecoins, where there is no world in which the organization is getting their money back because that money is gone, yeah, you have to be really careful about who you allow ACH debits to, which I'm sorry, Matt, brings me in a roundabout way to your original question, which is RFP, which eliminates all of that, which is, hey, as soon as the consumer hits approve, the money's in the organization's account and it can't be taken back. And that's the key part of that. And so we're seeing a lot of people really want RFPs and are willing to do RFPs, and consumers like the user experience. The problem right now is adoption and coverage. And, the three of us, to look behind the curtain, the three of us talked about this yesterday. RFP coverage is the biggest thing that's preventing this from being widespread. It's not available at all banks that support FedNow today. It's only available at a fraction. There are some additional restrictions on top of that. But I think once that becomes more and more popular, I do see that as the predominant way that consumers interact with the debit systems, because it's taking a modality, approve, deny, that they already know and love, and just applying it to a much wider base. And so I'm very excited for the future of RFP. I'm a little tentative on the timelines, and that's what causes me to reserve a little.
There is one rail we haven't talked about a little that can sort of bridge the gap there. So obviously on the credit side, we have push to card. On the debit side, we have AFT, affectionately called pull to card via Visa Direct, MasterCard Send, these other networks. Dan, I think this is something that's already seen a bit of traction in the on-ramping space. While RFP is not necessarily something that has gotten full adoption yet. Do you want to talk a little bit about how you can use pull from card to sort of handle that money in the same way that the Visa and MasterCard networks can be used to push it out?
Yeah, definitely. I think to Sam's point, obviously there's a little bit of a difference between an account funding model where it's a fiat wallet that's being funded, and then the account funding model where ultimately a stablecoin wallet is being funded. But I do think it's fair to draw a distinct parallel there. And effectively, it's an extension of kind of the same model. And so all that said, there's, to dramatically oversimplify things, there's two main transaction types in the card networks that can be used here, one of which is purchase. Obviously, like there's a derivative tree here, which is like purchase, card not present, and or card present. Ignore that for now. But there's purchase broadly, and then there's an account funding transaction, or AFT, which historically has been used to fund more traditional neobanking and or fintech wallets, a la Venmo, when Venmo came out, and others in that broad category. And so I would say to stablecoin builders out there, if you are aware of this transaction type, it's definitely something worth exploring. And we, shamelessly would love to chat through what that could look like. And secondarily, if for folks listening that aren't aware of that possibility, the kicker is basically that it's a streamlined way through which debit cards can be used to fund an account, and effectively that infrastructure can be linked up to the purchase of a stablecoin in a way that has, in ideal cases, better authorization rates, kind of a slightly different chargeback model, and kind of other implications that lend itself well to this particular use case. And there's broadly work to be done at the card network level here to kind of right size how the categorization of these transactions work in the network, and how from end to end the flow works such that these are ultimately being approved by card issuers in a way that's optimal from a consumer experience perspective. Ultimately, like there is fraud risk here, right? Because on-ramp is a fraud risk vector. And so that I'm not diminishing at all the work that will go into kind of right sizing the rule set at the network and kind of bank level for these particular payments, but I think it's a worthwhile investment, and I do know, that there is significant work being done to do, or rather, kind of commercialize this transaction type at the card network level for this purpose. So, yeah, I think it's definitely worth exploring those out there that are kind of interested in consumer wallet funding use cases where a stablecoin out is the kind of terminal point of the transaction.
For sure. We've just spent 10 minutes talking about, 5 or 6 different rails on both sides that can be used. I think the key point here is you no longer have to live in this world of wire in, wire out that's been used for the more traditional use cases of funding, your account on a crypto exchange for trading Bitcoin. Now we can get to real instant payments use cases, and you can adapt to your needs, whether it's low cost with ACH, whether it's instant, whether it's allowing the ability to use cards to fund or pay out. So there's a lot of options here, and then that extends as well internationally. So we've talked about ACH here, but of course you have SEPA in Europe, you have BACS in the UK. I think these same topics can be applied there if you're looking to bring your business overseas as well.
If I could just add one thing, Matt, I think the one thing I would add on top of your statement, and the one thing that I think maybe I'm trying to drive as a thesis statement either for this talk and for the previous one that the three of us have done, is that the fact that we have spent 6 minutes talking about all these different rails, I think is the indication that businesses, organizations can't just exist in a single rail world anymore. That doesn't happen anymore. You can't just say, oh, I'm ACH only forever, I'm paper checks only forever. Like, we are clearly moving to a world in which different end users want payments in different ways. And so I think it's just maybe a harsh reality, but it's reality nonetheless, that as an organization involved in payments, if you're paying out consumers or paying out businesses, you have to think beyond just one rail. Like even 2, 3 rails, like there are differences between all of these rails. And we've already, we've barely skimmed the surface on the differences between all of these, but it just further proves that there is no one perfect rail. Every rail has a trade-off. Every rail is designed in a specific intent and way. And so it's just deciding to interact with them in the ways that you want to interact with them. But you can't withdraw and say, I'm just choosing this one, because then you're not choosing enough trade-offs from the entire group. So I think I just want to make sure that people understand like that we're rapidly, or we've already been in the world of multiple rails for at least a few years now.
Yeah, before we move on to the next topic, Matt, I just wanted to add one more comment to Sam's point as it relates to kind of a multi-rail reality, to bring it down a layer towards broadly the stablecoin ecosystem and broadly kind of crypto market structure. I would emphasize the same point. So if there's folks out there that have historically, competed in broadly kind of brokerage and trading activity, if there is interest in moving towards payments activity, we'd love to chat about what it could look like to kind of right size your fiat payment infrastructure to allow for more flows to persist broadly using your infrastructure. And I do think that across the board, we've noticed a lot of interest from market participants in that regard, and that it's the kind of beginning of an evolution there. So anyway, I don't want to take us too far off track, but I want to double click on a particular segment of the market that I think stands to benefit from kind of embracing this reality.
No, that's a great point, Dan. I want to jump into the questions we have. We're already halfway through, so we've been ranting about Rails for almost 30 minutes now. I want to jump into the questions and start to dig into those. The first question I want to cover is a question about how the difference between these domestic fiat rails that are instant. So, with domestic rails like FedNow and RTP already being instant and 24/7, does the blockchain have a place here? Is there still an advantage if you're moving money instantly domestically, or is the value add really in cross-border? And something that's very topical going on in Washington right now that I'd love to cover here is a little bit of the yield conversation in terms of when you're pulling money in that delay from sending money out on the right hand, how that can be of use to companies. Dan, let's jump over to you first.
Definitely. Broadly, there's still discovery to be done as it relates to stablecoin and kind of blockchain utility for domestic payments. In my opinion, there's plenty of work and exploration happening. I just wouldn't say that I've yet seen much there that would suggest that stablecoin should be used as a replacement or a full alternative to RTP, or more recently FedNow, or to bring it back to the Visa Direct point, even something that the card networks can offer that offers credit and strictly credit initiation based money movement. That said, there's something interesting broadly with the concept of intrabank settlement that I think is fascinating right now. I'm still kind of defining my personal thesis as to where exactly this would fit, but to kind of bring it back to the point around like crypto market structure and crypto market participants right now, given the fact that a lot of them are banked by different institutions, given the fact that a lot of them are built on top of primarily wire-based fiat money movement, there's only so much efficiency that can be realized by intra-institution net settlement and same bank instant money movement using a shared bank system like something like across FedNow or Cubics in market. And while a blockchain based solution to allow effectively for money movement across these institutions using a non-bank network is maybe not the only solution, is definitely worth exploring as a solution to the fact that liquidity management between crypto market participants is super inefficient right now. And there's other reasons for that we probably don't need to go into right now. But that is a compelling domestic use case that I wouldn't say is necessarily payments, but it's more liquidity management and settlement, which is obviously a derivative of like the payments layer. And so, yeah, I think jury's still out on that front. Watching that space keenly, personally interested, but haven't yet seen anything tangible yet in market. Though there have been some projects that have been funded in the past like 6 months that are worth watching.
Really interesting there in terms of the net settlement side. Obviously, you having a background at Visa, this is a topic very well in terms of settling between banks. Something else I want to touch on here is sort of that intermediary phase. So let's take a tangible example. We have some payroll customers, so they're pulling in money from an employer to prepare payouts, to prepare tax payments and everything. That money's going to sit there for a couple of days. Obviously, that money, in some cases, if you're a large-scale payroll provider, you can park that in accounts that generate yield, but not every business is going to have an established banking relationship here. Given what's been set up with the Genius Act in terms of the ability for third parties to offer yield on stablecoins, is that an interesting use case that you see delivering value to companies where they can gain additional revenue on that intermediary phase of holding the funds before the final payout?
Is that one for me or Sam?
That's for you, Dan.
Gotcha. Yes, it's definitely interesting. Especially in even the past like 2 or 3 months, I'd say the general appetite is shifting towards openness, but maybe not yet full, like let's dive in terms of the usage of stablecoins as a way through which yield can be generated. I'd say like at a macro level, the ask that we've been receiving is how do I get yield? I think from what we've seen thus far, the preference would likely be that it's a fiat-based yield source. That said, we have had discussions with fairly traditional businesses and asked what their stance is with, or as it relates to stablecoin yield. And they haven't necessarily jumped right in. There has been an openness to engage, and I think the tone is shifting. And so, like anything, I don't think change can happen overnight, but I do directionally, I am seeing more people engaging on the traditional side of things than ever have, and that's very much in thanks to things like the Genius Act and also the rise of additional yield-bearing stablecoins and other kind of assets that could be utilized in a way that people can get comfortable with and that can be bankruptcy remote and safe and issued by qualified institutions. But yeah, I think it's still earlier days there. And then, like anything, there's kind of a dichotomy between crypto natives and stablecoin natives, and call it the real world here. I'm mostly speaking to the kind of real world, and obviously, if there are a bunch of projects in the stablecoin native landscape that are more fully embracing on-chain yield and other yield-bearing assets across many dimensions.
Yeah, I think I would also add that, like, in a general sense, and I think most of the people who are listening to us are aware of this, but I'll repeat it. If you have a pot of money somewhere, whether it's stable coins or in fiat, like sitting in a bank, you should be getting something for that. If it's not direct yield, which is high these days, right? Interest rates are pretty good if you have a pot of money at a bank. You should be receiving, in my opinion, some amount of value for it. And if you're receiving 0% interest, hopefully you are receiving value in a different way that is commensurate with what the prevailing interest rate is. And so I think that's what I would say, is that, like, if you're not gaining direct yield in your strategy of choice, you should be getting value somehow. Because I think the way the markets are going, and we've seen this with a lot of our customers at Modern Treasury, having a giant pot of money somewhere can make you money and should be making you money in the very real sense. It depends on how you want to extract that value.
Super interesting. Yeah, I think obviously it's a question of what is possible, but stablecoins provide an interesting alternative on the market today. We are sending out a poll here that I want to publish right now, which is asking, we want to get your feedback here. So we're curious to know, is yield important to your stablecoin strategy? Is this a core factor in deciding how you integrate stablecoins into your payments and treasury flows? Perfect. We're getting some really quick feedback here. Early insights show the answer is a resounding yes. Dan, Sam, any thoughts on that?
I think that's awesome to see. I actually was expecting a slight skew, a slightly more even kind of distribution here, but this is awesome, and directionally, I think the way that the market is heading. One thought that just kind of arose in my head as you were asking that question of the crowd is, there's a really compelling concept in stablecoin land that I think is important to understand about how yield generation with stablecoins can happen versus how it can happen with fiat broadly. And again, I think to Sam's point, it is of our opinion that yield generation should happen on a pool or a pot of cash. I think in a fiat-only world, what can happen is that your cash sits idle in a bank account, and it can be used for the purpose of collateral and or a reserve and or a pre-funded account to allow for some other payment method to persist. While that is unavoidable when you're using fiat systems, there's a really beautiful concept that can happen when money arrives on a blockchain and stays on a blockchain, wherein yield can be generated on not only idle money that's sitting in an account, but also money in motion across the ecosystem, whether that be in a P2P payment or a peer-to-peer payment, whether that be for a corporate treasury use case, whether that be for a cross-border payout or some other new use case that some developer around the world cooks up. I think that paradigm shift is under-discussed in kind of the broader landscape, the broader fintech and payments landscape, and in my opinion is one of the most compelling components of why stablecoins are interesting. Again, it does assume that there's a version of the world that exists where value can stay on a blockchain for a long time and still be usable. And there's a bunch of different projects that are focused on how to make that reality a thing. Our infrastructure at MT allows for value to come from the fiat system and go onto a blockchain, and then leave a blockchain and come back to the fiat system. So we will let the market decide how this all fares. We have a neutral infrastructure that lets developers do what they want per their use case. But anyway, I digress slightly. If that is an element of stablecoins that is of interest to y'all, or is something that you haven't thought of, I would encourage you to think about that as kind of a compelling angle to evaluate, or rather lens through which you can evaluate stablecoins as a not only an alternative, but also as a kind of an accretive like revenue source for your business, and a tool that can be used in a way that previously was impossible in the fiat system, or maybe not fully impossible, but at least a lot harder.
Super interesting. I think something a little bit tied to that is the rise of new coins and new chains, each of which offer different incentives. I want to talk a little bit about that because we have a question from one of our participants who's asking about how companies are thinking about L1 chains, L2 chains. So obviously We had the news over the summer with Tempo rolling out a new chain. There's the L2 networks as well in terms of Arbitrum, Optimism, Base. Dan, there's a lot of incentives here. There's a lot of opportunity. How does that factor into the decision making that companies have in terms of where on the blockchain they're actually putting this money?
Let's see. It is good that there's experimentation continuing to happen within the L1 or L2 space, the layer 1 or layer 2 space. I personally think that we have enough chains, and I think most businesses aren't going to force a chain unless there's some incentive that they have directly with that chain developer system that would incentivize them to use the chain, right? Which does exist in crypto and in blockchains broadly. And it exists in other payment methods too, right? There's incentives to use a network. That said, I wouldn't say that most traditional businesses are coming to us with a chain direction. I think they kind of want to use a stablecoin, and they want to use the possibility of a stablecoin to, as we were talking about, either get a different type of yield or move value more efficiently. And they want for that tool to be used on a fast blockchain and a cheap blockchain that is reliable and won't have downtime, very importantly. I think yet again, like there's that world, and then there is also the crypto native or stablecoin native world where people are very opinionated about the blockchain. And so I think market reality is that infrastructure developers need to be multi-chain as well, much like we need to be multi-rail. And ultimately, I think modern treasury's ethos and stance on this is that we don't intend to king make, we don't intend to pick one ourselves. There's a very low likelihood of us ever launching our own blockchain. Therefore, developers can ask which chain that or rather tell us which chain that they'd like to go live with, and we would support that chain. Jury's still out about if that changes, but I'd say ultimately I think that's probably a fair perspective of what we're at least seeing right now. So I'm not sure if you'd have any other comments.
Yeah, I mean, I kind of wanted to give the engineering insight on this because, that's my background. I'm an engineer. Being faced with, and I don't know the exact number, but let's say 10, 12 L1 chains, they are very identical. I know that might be a slightly controversial take, but they are extremely identical to another, almost like imperceptibly so. Like they're all basically the same. There are clear winners, and I think you're right, Dan. No one's coming to Modern Treasury and saying, I want this chain. They're saying, I want this stable coin. And mostly that stable coin exists across multiple chains, all the chains. But from a developer experience, there is a cost to switching between them. There's a cost to maintaining all of these. It would be the equivalent if we had not two, RTP FedNow. Be the equivalent if we had 12 RTP FedNow systems, right? There's not a long-term market scenario where 12 FedNow systems survive. There is a market scenario where two survive or three survive. And I do love the innovation. And I do like that, Solana is a completely different underlying technology from something like Ethereum, and a lot of chains are Ethereum based. So from an engineering perspective, I see the industry consolidating down to a handful, all with their strengths and their weaknesses. But yeah, I think this just adds to the complexity, right? Because if someone wants to take this on their own, as an organization, oh, I want to do stablecoin providers. The question that was asked, oh, should I do RPC calls to all of the chains? That's a lot of work, and there's a lot of bookkeeping involved internally. I think what I would recommend and what we're seeing in the industry is use an API provider. It doesn't have to be Modern Treasury, but use a provider behind the scenes that abstracts a lot of that away because functionally it's all the same instruction. You're moving value from A to B. And, not to talk about Modern Treasury too much, we've taken a step further and we say all value transfers, both fiat and stablecoin, are just extensions of that. You're transferring value from A to B, you're saying a specific amount, maybe you're including some information in it, but generally how it actually flows down to the network, that's the responsibility of who you choose to manage those payments. And there's a lot of work behind the scenes because there are so many chains involved, or can be at least.
For sure. Thanks for the feedback there. I want to completely pivot here and really get into the weeds on implementation and the actual experience. Sam, I'm going to jump over to you because I know you have a ton of hot takes here. On the fiat side, we've seen improvements over times in terms of remittance information that's passed with payments. So obviously we had the transition to the ISO spec this summer for FedWire. We have very established processes for ACH addenda. In the stablecoin world, it's a little bit less so, also in instant payments, to be honest, with FedNow. I'm curious to get your take on how companies can handle the lack of data that's included on these instant payments, both in the fiat world and especially on the stablecoin side.
Yeah, I think this specific issue, I think, from a engineering payments perspective, is probably the single biggest blocker to stablecoins being accepted as a rail, as a rail for consumer payments or business payments. Every single payment system has a mechanism for transferring information alongside the payment. And in stablecoins, or in specifically, Ethereum transfers, Solana transfers, you don't have that. I mean, you do have the ability to broadcast broadly a message and include information about that message, but that information is public. And the amount of people who want to include public remittance information on a public blockchain about their specific payment is approximately 0%. No one wants to do that. And I think that's a huge problem. And, coming as a non-crypto native person, this is something that I've been asking a lot of questions about behind the scenes. This is something we've been working on internally to figure out a potential solution for. But the lack of a way to exchange data between two parties confidentially in the stablecoin systems is, I think, a big miss. And the reason I think it's a big miss is because everyone expects that coming from the fiat world. But also, this is just something you need to be widely accepted. You need to convey information about the payment. And I think what's so tough about cryptocurrencies and remittance information is that cryptocurrencies are built on this engineering ideal that everything's out in the open, everything can be verified, everyone has the same view of data. And that's fundamentally incompatible with this desire to privately communicate a little bit of information about a specific payment to the recipient. And so this is something that we've been working on. We've been trying to ask a lot of questions on. If I had my way, I think over the next 2-3 years, the industry will develop a SWIFT-like system for exchanging information about a payment, both remittance information and regulation, compliance data like travel rule data, in a SWIFT-like messaging way that anyone can join that is independent from the actual transfer value, which happens on the blockchain. So that is my hope and my desire. I think that is what the industry needs to get even further widespread adoption, but I do think it is a significant blocker. I wish I had a direct answer to this question that was like, oh, do X, but there isn't one, and I think that's a real issue.
Interesting. Dan, you've been moving stablecoins at scale for a while now before being linked up with modern treasury. Do you have any war stories here in terms of how you navigated this?
Plenty of war stories. I'm going to go a slightly different direction and pick up on one of the points Sam mentioned first, just around what's necessary to bring these systems to scale, these tools to scale. And ultimately, that's what they are. These are tools to move money and to do other things. They're financial tools, though. So to Sam's point, broadly, mainnet Ethereum, kind of mainnet Polygon, mainnet Solana, and various other chains that are being used and have been used that have kind of reached their critical mass of usage, and a lot of which you probably think aren't going to go away, right? Don't natively have the capabilities that Sam alluded to built into the protocol. That said, there has been experimentation on this front. For example, Solana broadly has rolled out the capability to add confidential messaging and assign that to a payment. That said, it's not very highly utilized yet, right? Moreover, here's another example. With the design of kind of stable coin chains that have come to fruition in the past year or so, Tempo is an example, Arc by Circle is an example, Plasma is an example in the Tether ecosystem, and there's various other ones. A lot of them kind of listened to the problem that Sam mentioned and said, hey, what if we built this into the L1, into the layer one blockchain, and included not only confidentiality, but also like the concept of payment memo in the protocol level. And I think that was the right design decision. I think the ultimate issue, though, is like there's not yet liquidity on these chains. There's not yet payment activity on these chains. And until there is, it's unlikely that people will go to them and actually try to use them for the purpose of payments, moving value. And so you have a classic cold start problem, chicken and egg problem, whatever you want to call it, with the launch of a new network, of a new product to your end. Um, the reality is that the usage will follow where liquidity is for the most part in blockchain land. And that's kind of what I'm seeing, is that these are, the Tempos, the various other chains, well-funded, amazing teams. Technically, in many ways, they've taken all the learnings of the past, like 10 to 15 years of blockchain development and applied them to these very possible, like, perfect payment chains. But, we got to see if people are going to jump on them, at the end of the day. And again, MT is neutral on this front. We will support chains where people want us to go. But that is kind of a nuance to kind of Sam's comment here. And then I think, Matt, a lot of stablecoin adoption to date has been imperfect. It has not yet been fully compliant with every exact regulation in fiat land, and I think that needs to change, is the honest answer to your question, for real usage of this technology to move the trillions of value that is possible to convert over to this rail on the long-term time horizon. That's not to say that the good actors are purposely avoidant of what's necessary to remain compliant, to utilize the proper travel rule compliant data to pass value from A to B. In a lot of cases, the tooling wasn't available, to Sam's point. And so there's kind of this concept that the innovation still needs to happen. And now I think we're at a point where the innovation has happened, or is about to happen, where people can start to use the tooling the way that they want to. And then secondly, like, to move from this, I'm going to call it like kind of an echo chamber, this crypto echo chamber, into mainstream adoption of crypto, market participants will need to accommodate stuff in kind of this new world that they didn't necessarily need to accommodate in the previous version of crypto and stablecoins. And that's a market reality. And I think regulation and things like Genius are going to force people to play a different game than was played in the past. And ultimately, the technology, the tool, and broadly the market will benefit from proper and kind of responsible usage of this technology that complies with existing regulation that is defined pretty clearly.
Interesting. I want to dive a little bit deeper there in terms of the risk and compliance aspect you mentioned. So obviously there's been some big headlines that have come out recently in the news where risk and compliance wasn't a priority for companies that were operating with stablecoins. What do teams underestimate from that aspect? Obviously, there's a question of the tooling. Is that tooling, are those memo fields, is the ability to pass through travel rule data even available? But as it is becoming more and more part of the core functionality, what do teams need to make sure that they're investing in and focusing on to be fully compliant whenever they're rolling out cross-rail functionality? Sam, I'll send that to you.
I mean, yeah, there's a lot of things you have to stay on top of, right? I think any time that you cross rails, and that's like your business is like, oh, I'm intentionally going to let people fund me with stable coins, and then I'm going to send out, US dollar FedNow. Whenever you have a business that's doing that cross rail stuff, you just have to always be aware of who is sending you the money and who are you sending the money to. And I think just to add on to what Dan just said about getting getting your ducks in a row really quickly about compliance, I agree. Like, I think anything that touches stablecoins should become a lot more compliant more quickly. Like, I think we need to enter this new phase where cryptocurrencies are not thought of as a Wild West that people can use to evade anything. We need to start thinking about it as a actual functional tool for moving large amounts of value between participants in a near instant way, right? I know, like, this is technically possible, although no one has done this, right? I could technically move $1 trillion to Matt Craig right now in a very safe manner. And I would know that everything about this is safe because I know that the blockchain is safe. I know that it's secure. I know that there are no issues. And there's not a lot of systems like that where I can just move $1 trillion instantly into another country. Now, I know that's a very far-fetched example, but with that power comes great responsibility. And I think there is an onus on companies, to your question, Matt, who are dealing with stablecoins, who are dealing with money transfer on behalf of other individuals, to really tighten up and to really make sure that they're doing things exactly by the book, because that's going to reflect poorly, excuse me, on the entire industry. And I think there's been a lot of cultural baggage that I think the crypto industry has brought into, the year 2026 that modern treasury would like to essentially start separating, right? I think this is a new dawn for cryptocurrencies. I think there's a lot of regulatory tailwinds behind this. Like, I think now is the time to actually get a lot more serious in order to unlock the volume, because that's what we see is the people who make the most money here move the most volume, and you're not going to move the most volume without having every single part of your compliance program down pat. And sometimes that means doing it yourself, hiring a ton of people who've done this before, or it means finding a partner who has done all this work for you and is ready to go to bat for you, who understands the space a lot more.
Super interesting. Unfortunately, we are approaching the end of the hour, so I am going to have to close out here. I think we could go on for 2 or 3 more, but we're going to have to close it out here. So I just want to say thank you to everybody for joining and going really deep with us. Who knows, maybe there will be a part 3 in the pipeline soon. But if there's one thing you take away from this session that we really want to emphasize, it's that multi-rail isn't a crypto strategy, isn't a fiat strategy. It's durability. It's planning for the future. So stablecoins are one set of rails, as we've learned, not just a single rail, but one set of rails, maybe 2, 3, 4, that are growing very quickly. The winners there will be teams that can orchestrate across them, that can transmit reliable remittance information to streamline compliance and reconciliation, and can be done so in a way that's scalable, where teams don't have to go back and rewrite their architecture every year to adapt. In terms of housekeeping, we're going to send over the recording link to everybody after the session if you want to follow up and rewatch any of this. If you want to continue the conversation or reach out to us to discuss in a little more detail your specific use cases, you can definitely reach out to us. We're more than happy to talk to you about early access to the new platform or chat with our team more generally. Before we go, though, Sam, Dan, any parting thoughts on your end?
Just to go in line with the theme of this talk and the one we previously did, multi-rail is never going to go away. And that's a constant. The other constant is we are seeing, if you take the last 100 years of payment history, the convergence is towards instant payments that are cheap and that are final. And if you just take the last 100 years and look at all the payment systems that have been invented, we're getting closer and closer to this, payment system. And so I would just encourage everyone in the audience to think about, like, what is your strategy, given that there are multiple rails and we're getting towards this new instant world. I would just, I would ask the audience, think about what you're going to do. Think about what your present plan is. Think about what your future plan is and how you can compete in a market that is going to expect those 3 things from you and going to expect them even more as time goes on.
Perfect. Dan?
I would just add to Sam's comment. As you are exploring your multi-rail strategy, regardless of how fully formed it is, if stablecoins are at all of interest, as a rail type, let us know. We'd be happy to chat and kind of think through what it could look like to add them in, whether that be for the purpose of experimentation or a scaled money movement. Personally happy to jump on a call with folks and chat through really anything that's on your mind. I think it's exciting. It's exciting times in stablecoin land. That's 100% certain. And we're keen to kind of hit the ground running in 2026 and beyond with folks that are keen to explore. And we're excited to hopefully be a partner deal.
Exactly. We've got a lot of really exciting announcements over the next few weeks, so keep your eyes peeled. In the meantime, thank you again, everybody, for joining, and we'll see you at the next one.
Thank you all.